This is the Equity Management Academy Mean Reversion Trading Weekly Podcast for March 16, 2022. Go long gold, silver, and Hecla. Today, March 15, 2022, the Russian invasion of Ukraine continues. Russia has asked China for military aid, probably financial aid in drones. The conflict may be spreading. China is under a lockdown for one city and some ports due to another wave of COVID infections. This is adding some additional supply chain constraints, which contribute to rising inflation. Inflation appears to be running at about 10%. If China and Russia start to act more in concert, the West could face severe impact in terms of food and energy supplies. The Fed will probably announce a quarter-point increase. A surprise would be anything higher than the quarter point. The market is pricing in about 25 basis points. We are watching the yield curve between the 2 and the 10-year notes. The curve is beginning to invert. Equity Management Academy CEO Patrick MontesDeOca said, an inversion usually is a sign recession will follow a few months later. End of quote. The supply chain for many goods appears to be getting worse again, particularly food. Russia and Ukraine supply a significant percentage of the world's wheat, about 30%, in part because the U.S. shifted to producing corn due to subsidies for ethanol production. The Americas are also facing severe droughts, which is hurting production of wheat and grains. Russia is also the second largest oil producer in the world and produces huge amounts of natural gas. For all the talk of green energy, MontesDeOca said, there is nothing that can replace crude oil and natural gas at this time. We are moving into a green economy for now, but it is in the distant future. End of quote. Crude oil went from $37 to $107 a barrel in 2 years, from a negative 37 to a positive $130 in 2 years. The Ukraine conflict can be seen as a war of a control of crude oil and natural gas, especially in the Sea of Azov region. It begins to look like the 1970s when we had an oil embargo. Gas prices shot up and with it, inflation. In California, gas has already hit almost $7 a gallon. Sanctions are collapsing the Russian economy, and now China may get involved. The global economy is under great strain. This is leading to a lot of volatility in the markets. As traders, we try to see where opportunities lie in the current historic situation. There are historic opportunities unfolding. Gold. Gold is breaking down to 1916. It is trading below the variable changing price momentum indicator, VCPMI, the buy-to level of 1924. It is down $44. Gold made a high of 2,078 on March 8 on news of the Russian invasion of Ukraine before coming down from that high. Now it appears to be in an oversold condition. We want to see the market revert. It could come down to the buy-to level of 1892, which has a 95% probability of a reversion back up to that level. A close above 1924 would activate a buy trigger. Silver. Silver is holding steady at $24.90 at the buy-one daily level of $24.85. The VCPMI expects that a reversion should unfold from this level back toward the mean. A close above $24.85 will activate a buy trigger. If it does not activate the buy signal, do not go short, since the market appears to be entering a major level of support. $24.85 is a major level of support. The buy-to level is at $24.44 on a daily basis, and the weekly is at $24.36. A strong harmonic relationship between the daily and the weekly numbers. They indicate an area that is a major buying opportunity to go long. The metals have come down to an extreme level below the mean. As we consolidate down here, there is a very high probability that buyers will come into the market. Silver and gold are at levels where it will be a great time to go long. Bitcoin is consolidating around the daily average of 38,502 and the weekly average of 39,577. It is in a neutral position and it is building support. We are letting the market consolidate and build a foundation for a move to much higher prices. Special situation. Hecla mining. On January 15, 2022, we published a silver report on Seeking Alpha. We discussed buying Hecla mining shares. We believe that it is an explosive stock since Hecla produces about half of America's silver production. It is the oldest silver mining company on the New York Stock Exchange. Hecla's was about 508 in January when we made the recommendation. The stock then ran up to 766, which almost met the target the VCPMI predicted. It then came back down to a level of support. We saw that low as another buying opportunity. The new low was 458 before running back up to 766 on the first leg of a pattern. This is the first leg of a major move up for Hecla. We now see some profit taken and a move back down to another area of support. This is an area to add to your Hecla position. We are buying Hecla because of the potential shortage in silver that is on the horizon. We have not yet seen the full effect of the supply constraints in precious metals yet, MontesDeOca said. I am focusing a great part of my portfolio in Hecla since we are buying an undervalued silver mining company. This is a buy and hold stock. We recommend buying Hecla on the dips and holding it for the long term. The prices for precious metals, gold and silver still have not yet fully recovered to their real mean based on the fundamentals, world debt, interest rates, and inflation levels. Expect them all to run up significantly.
Thank you for listening. If you want to learn more about what we do, please go to the Equity Management Academy, EMA2Trade.com, or listen to any of our previous episodes.